Since we've talked about credit, we've talked about taxes, now we're going to look at how you can make your money make you money. All right. So the start off question that I want to ask, and I want you to write the answer down to this, is if you could have $100 right now or $150 in a year, which option would you choose? Many of us use banks, but we don't necessarily know what banks are. Now, the reason that question was answered because it's the primary question that is posed to people when they use a bank. All right. Banks are started by investors and they pool their financial investments, money, property, and other funds to provide banking services for the community. So a bank is there for the community to help them out in their financial needs. Now, for this right here, I don't want you to write this down, but I'm just going to say it. Banks operate because they need continually get funds. The more money they accumulate, the more money they make, the more money they have to loan out and give to consumers who need it. This way, if they have more money, they can continue to make more profits and offer more services to their community. Now, banks make money by having people deposit money into the accounts that they offer, and they use that money to make loans to other customers who need money if they're in a tight situation or if they're trying to do something that they need a large amount of money for. Now, a bank offers different services. They offer checking accounts, savings accounts, and certificate of deposits. Now, these are things that are offered to customers who need financial services. These accounts all have interest attached to them. In this instance, when a bank offers you interest, it's a good thing. It's not like when you have interest that accumulates for a purchase when you use a credit card. When you have interest that accumulates in a banking account, it's going to have your money make more money. Now, that sounds like a wonderful idea and something that everybody should do. But the reason why people don't all just put their money in the bank is because they realize that banks have to make money off of us too. So how do banks make money? Banks are going to make money by loaning your money out to somebody else. Now, here's a quick scenario that I want you to look at. Let's say Shauna goes to the bank. She deposits $1,000 into her banking account. Now, the money that she just deposited into her account technically belongs to the bank, and they can do whatever they want to with that money. The bank is just a place that safeguards your money and protects it. It can do whatever it wants to with it, though. So when you deposit your money in the bank, your money goes into a big pool of money along with everyone else's, and your account is credited with the amount of your deposit. The bank is then going to use the money that Shauna deposited for its own benefit. So let's say Dante comes to the bank. He's trying to start his own business. He needs a loan. So Dante asks for a loan. A portion of the money which Shauna has deposited into her account now goes to Dante for his loan. The bank does this because it helps create money for the economy when it makes a loan. You have a person who comes in for a loan. His name is Dante in this scenario. And in this scenario, he's starting his own business. When you start your own business, you help make more money for the economy. So it's a good thing on all sides. The last thing with the scenario is that, next to the last thing is that the bank has to make its money off the transaction. So how is it going to make its money off the transaction? It's going to charge Dante interest on this loan in which he's taken out. So now that Dante has been charged interest on top of the loan that he's taken out, the bank is going to make money with that interest. When Dante pays or repays the amount in which he took out for the loan, three things are going to occur. The bank is going to make a profit because of the interest in which Dante was charged to take out the loan. Dante has now repaid the money in which Shauna has used for her original deposit, and now the bank has accumulated more money. So the primary functions of a bank is to use their account holders' money to make more money by lending it out to others, to invest in homes, businesses, and even to use for college. Now, what would happen if everyone went to the bank and took out their money at one time? We would be in a pretty bad and tight situation. There are protections against that. You have the Federal Reserve Act, and that requires the bank to keep a percentage of the money on reserve and not let it be lent out to other people in the form of a loan. We have the FDIC. The next time you go to the bank, you should see this plaque on your bank's wall or on the counter. The FDIC stands for the Federal Deposit Insurance Corporation, and it protects people's deposits up to $100,000. The next biggest thing that protects us is that the banks are regulated by the government. The government lets the banks know how much they should lend out, how much they should keep on reserve, and how much money they have in circulation. Now, there are different types of banks in which people can use. You have a commercial bank, and then you have a thrift institution. You can take a look at the slide to see the difference between the two. They both offer similar services, though. A savings and loans bank and a credit union, they both started off in different forms and in different methods. Credit unions are the next most common banks that are used by individuals because credit unions are offered or they are built for people who are in a common industry. or in a common profession. Credit unions are a great resource because they offer loans out to people and offer services to people at lower rates because they're not trying to be a commercial bank and make a profit off of their customer. They're trying to help out people who are in tight situations. Now, to bring home the point of how banks make money on the interest that they charge for loans. The interest rate that a bank is going to charge a person is going to depend on both the number of people who want to borrow money and the amount of money the bank has available to lend. The interest rate in which the bank charges for people to make these loans is going to be markedly higher than the interest rate that they charge the people who deposit money into the accounts. Therefore, a profit is going to be made. Another way in which a bank makes money is through the ATM fees and the other services that they offer as a convenience for their customers. Now, this is how banks work, this is how they operate, and this will let you know what you should look out for when you're going to select a bank for yourself in the future.